Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So one of the things that I've been doing last couple of days is just researching about companies that are undervalued at the moment, and I'm talking about high quality businesses that have maybe just kind of not loved right now for a million different reasons. As you know, Wall Street and retail investors do not have the patience to wait for stock to bounce back, so they might have one quarter where they didn't do well or something has happened to the business, and they just focus on the next quarter or next year rather than looking into 5-10 years from now on and just doing some sort of analysis and look basically for high quality businesses that have been kind of unloved, if you like. And that's what I've been trying to do in the last few days, and one of the companies that I've actually come across today is in that category. So I'm going to share that with you guys in a second, but before I do that, it takes a lot of time and effort to do this research and put these things videos together. I would really appreciate if you can like the video and subscribe to the channel. Right now it's about over 50% of you again that have not 50%, 49 or whatever percent of you guys have not subscribed to the channel, and you watch these videos regularly. So I would really appreciate if you can subscribe, because so you don't miss out anything. Like the videos, it doesn't cost a penny, and of course if you want to join us on the Patreon account, that would be absolutely wonderful because it does support the channel, as well as of course you gain access to all of these things, including the Discord and access to the Discord, inshallah. Right, let's get started with the company that we're talking about today, and that's Texas Instruments Incorporated. This is one of the semiconductor companies, and for the 1 year it's actually basically down about 2.68%. There is not that many companies in the S&P 500, I can tell you that much right now, that are actually down for the year, especially in the semis. We're talking about companies like Nvidia's and AMD's that are up 200 something percent. Even Qualcomm is quite a lot. So right now this company is actually down to minus 2.68%. so what I'm going to do is going to give you an overview, and of course if you're really interested in this business, go and do your own research. Don't just rely on this, okay? So in terms of revenue side of things, since 2013 we're looking at about $12.2 billion, and to right now about $18 billion. So it has increased to this, okay? And more or less every single year it has consistently grew that top line. The reason we focus on this is because of course if the company is not making sales and the sales are not growing every single year, then what's the point of investing in these businesses, right? If you own a little shop, you want to make sure that you're actually making money, and by actually increasing that top line and of course returning some of that money as well. So the net income, that's why it's important. So 2.1 to right now 7.21. So in the last 10 years, which is absolutely beautiful to see, and it has been growing for going up to the right direction, which is quite nice to see. We'll come back to Seeking Alpha in a second, but let's go to Simply Safe Dividend. As you can see here, it pays 3.16 dividend yield. It has a market cap of $151 billion, and it has a very safe dividend yield right now. Now, moving on, payout ratio of 64%, slightly higher than what I would like. 64% is quite high, but I think in the next couple of years, I'm sure that will basically come down. Now, the latest increase was almost 5%, the 5-year growth rate of 17%, and the last 20 years, they've actually grew this dividend about 22%, which is quite nice. So they've been increasing that consistently. And as you can see here, it's beautifully been growing in the last 19 years in a row. So 19 years of increasing that dividend, and uninterrupted dividend streak of 61 years. So they never reduced for 61 years. They have not reduced it at all, and they have been increasing for 19 years, which is quite nice for a technology company. The annual payout, so this is what you will receive per share, okay, that's $5.20, which is quite nice. And these are the dividends, as you can see, the payout for each month in the year. Now, it might be undervalued according to Simply Safe Dividend and according to the dividend yield model, and the 5-year average is 2.77, and right now it's looking about 3.16. So if the current yield is higher than the 5-year average, then that means the company could potentially be undervalued, okay? Of course, there's other things that you have to take into consideration, but that's kind of the dividend yield model kind of thing, if you think. 23.2 and right now 26. So in terms of looking at the forward PE, it actually looks like a little bit overpriced right now, or overvalued if you think about. Now in terms of earnings per share ratio, we've already seen, okay, 64%, and next year so going to increase up to 82%. Normally we're looking about anything below 50%, which is quite nice for this type, for the semiconductor companies. But right now it looks like it's way higher, and it's actually going to increase. And same goes when you, even if you use the free cash flow payout ratio, is 273, and then next year is 180. So that's declining in a way, but this is actually going up. So we'll prefer 50%. Basically it's the below 50% is basically the target that we're looking for, but is way high in terms of that now. Free cash flow per share is, as you can see, it has basically declined quite a bit, and that's probably why we're seeing all of this. But the next year, next 12 months, they are expecting it that to bounce back, so I'm sure that shouldn't be a huge problem going forward. Now shares outstanding, the company has been buying back their own shares, and total sales has been going up until 2022. Now 2023, they're expecting the earnings to decline a little bit, so the next 12 months. So I think they will report very soon. Once they report, I think that will be their final, and we will know then what has happened to the 2023 year basically. So we will see what happens with that. Return on capital, we're looking for return on equity, 15%. That's what we're normally looking for. 56% right now. Return on invested capital of 28%. We're normally looking at about 12%, which is quite nice in this situation. Operating margins of 43%, and free cash flow margin of 9%. Normally we're looking at about 5%, and net debt to EBITDA right now we're looking for below 1.5. right now is 0. Next 12 months will be 0.27, which basically means the company has absolutely have no issues in terms of that side of things. Now going back here, we're going to look at the earnings, basically what this company is expected to earn in the next couple of years. So in 2023, and I think they've got one more quarter to report, and then that will close. Okay, they're expecting a decline of 26%. Probably that's why the company is down quite a bit. 2024 as well as that, of course, is decline of 6%. But then after that, there's about 14 analysts that saying it will bounce back in 2025, which is not far if you think about it, it's just next year, 18.25%. Then after that 26%, after that 11%. So if we just use the two threes here, you can see we're expecting double-digit growth in 2025, 2026, and 2027. So the following 3 years. After that, bit of a decline, and then more or less same goes for the top, the revenue side of things. A decline of 12% this year. Then it bounces back for about 1%. Then almost a bit, double digits for the following 2 years. And even if we use this one, is about 9%, which is quite nice to see. So it's growing from $17 billion to $24 billion in 2027. Now if we look at Morningstar, there's also expectation. Of course, this year we've already seen the decline, and then 10% per annum for the following 5 years. So they're averaging out the numbers that we've just seen, and that's basically what they're predicting. So now in terms of valuation, so where do we think the price should be for this company? Right now, according to TipRanks, is actually hold. There's 6 buys, 12 holds, and 3 sells, and $162 per share is where they think the price should be. That's a decline of 1% from where it is apparently right now. In fact, you just need to update that because that's slightly higher. Yeah, actually that's about right, I think. And then if we go back to Seeking Alpha and we go to ratings, as you can see here, you see Seeking Alpha analyst is actually saying a buy, Wall Street is actually saying as a hold, Quant is actually saying a hold. So if we look at Seeking Alpha, it's actually flat. So it's basically where it is right now that they're expecting the price to be. And there is, if you know, 9 of them are saying basically it's a buy, 2 holds, and then 3 sells, which is basically what we've seen with TipRank as well. So yeah, overall buys in here, we don't have any strong buys for Seeking Alpha analysts. 7 buys, and then 6 holders, no strong buys in that situation. Right, so the final thing I want to do is I want to show you using my own my own discount cash flow model. And again, this is my own analysis, so you're going to have to take a pinch of salt. Morningstar is saying it's $155 per share right now. Multiples valuation, which is what I've done, gives me $185, and Simply Wall Street is saying $169 right now. Discounted cash flow model of 170, which gives us this value here. Now, if I use the dividend discount model, which actually gives me, I think it was, if we go back here, 265 US dollars, okay, I end up with $189. So if I take out this, I'm going to use the 4 here, okay, I'm just going to leave that one out and I'll show you in a second. So in terms of discount model that I've used, you can see here I've basically looked at the free cash flow over the last 10 years. We're using the analysis saying 10% growth expectation for the next 5 years. We're expecting about 8%, so we go into moderate, perpetual growth rate of 2.5 and discount rate of 8%. We're looking at the cash and cash equivalents of $9 billion, total debt, which is about $8.7 billion. And then that gives us the equity value, and then we divide that by the shares outstanding, which gives us discounted cash flow price per share of 170. Okay, so that's basically where that comes from. And then multiples, we're actually comparing with the Qualcomm, Broadcom, and the NXP Semiconductors. So the 3 companies that we compare, basically in a similar sort of industry. And then we've taken all the cash, and all the dividend payouts for the last couple of years, and then we used an analyst growth rate is 10%. Again, we're using 8%, and then discount rate of 10% in this one. That gives us, so we can basically play with the numbers here, but overall 164 is where it is right now. Intrinsic value, the average intrinsic value from these 4 models here gives us $164, which is actually relatively, I mean, it is good. It's only 3% difference. So if I say now I'm going to buy this company, but I need that margin of safety, which is really important. Whenever you're buying any of these stocks, you always have to take that into consideration, that 10%, 5%, whatever it is for you. So if you say that I just need 5%, that will take you about 161. That's about basically where the stock is at right now, just about $3 shy of that. But if you say, okay, I need that 10%, again, it can easily happen. 165 is not actually, this by the way should be in US dollars, so not in pounds. Yeah, and that should be absolutely fine. I'm sure you will find this stock based on where it has been in the last few months. Let me see when it was last in 140 was October the 30th. It was actually 140 US dollars, and just before then it was just that. So yeah, of course you can easily find this stock around that price if they basically the way we see some sort of a crash in the market, or even the way things have been in the last couple of days. Because even if you just look at this week, okay, even if you just look at the last 5 days, the stock's down about 2%, okay, or basically 1.6%. So of course you might get that price in the next couple of months. So just for full disclosure, I do own this company in the family portfolio. It's a recent addition to the portfolio. So I bought it, I think it was around 160, 161, whatever it was. So yeah, it's just maybe down a little bit at the moment, and I really like the business and I'm going to continue buying. That's basically just to give you a bit of a full disclosure there. I hope you're enjoying this kind of content. If you are, please join us on the Patreon account. Of course, like the video, subscribe to the channel. Let me know if you have any questions. Have a wonderful day. Assalamu Alaikum.